Are you confused about the investment markets? Well, join the crowd. Stocks have periodically suffered catastrophic declines only to rebound as much as 50% in the months that followed. And the future of the economy and the investment markets is far from certain. Fortunately, money help is on the way in the form of my generation's financial editor, Jonathan Pond, who is here to provide his rules for successful investing in an ever-changing market. Jonathan, good to have you back.
Thank you.
Now, you talk about the golden rules of investing. What are the golden rules?
Very simple. You can't predict the market. And those who think they can should be encouraged to seek immediate mental health counseling. Once you understand that, then you can diversify your investments, not worry about trying to time the market, get in, get out, and over the long run, you'll do fine.
Now, Jonathan, you say don't let your age dictate the way you invest. Now, I've been told just the opposite. So what do you mean when you say that?
That's right. Even for people of, say, more advanced years like you and me, you generally don't change the way you invest very much because the way you invest is dependent on two things. One, when you're going to need the money. And that's what a lot of retirees think, well, gee, I have to invest a lot for income because I need the money. But not only it's when you're going to start needing money, but how long it's going to last. And for that, you need to invest for growth. So all of us need to invest for growth and income. Hence, a 60-year-old wouldn't invest very much differently than a 70-year-old.
Really?
That's right.
Now, you also talk about rebalancing your investment portfolio periodically. I was told just the opposite. Why that?
Well, rebalancing is a way of simply getting back to whatever target you have. You have to set a target. Maybe you want 60% of your money in stocks and 40% in bonds. And the markets change, as we all know. And every 6 months or so, look at where you stand. The market may be up. Maybe you have 65% in stocks. Well, get back to your target. That means you're selling stocks in a rising market and buying stocks in a falling market, the opposite of what people want to do, but it's the right thing to do.
Now, Jonathan, just for our viewers that are still in the workforce, maybe those who also have family members that are in the workforce, what information do you have for them?
This relates to workplace retirement plans, things like 401k and 403b plans. There's a hidden trap with these plans because most of them have 80 to 90% of the choices are stock fund choices. And what happens then is that they end up, people think they're diversified, but they have too much money in stocks. So pay attention to your workplace retirement plans. Don't overload in stocks beyond your target allocation.
Now, you say it's okay to be an average investor. Average has never been something that sounded very good to me, but there's a reason for that.
Studies show, Greg, that most investors do far worse than average, and average is pretty good, and that's why I suggest you invest in index funds and exchange-traded funds which replicate an index like the S&P 500 or a bond index. Be average and you'll do fine over the long run. Also, the costs are a lot lower for these.
Okay, now you talk about short-term investments and also having a certain amount of cash, I guess, on hand.
Yeah, you need enough cash to last for a while in turbulent markets particularly. The key with short-term investments, things like CDs and money market funds, is to shop around. When interest rates are low, shop around. You'll do a little better. Avoid high-risk investments, though, those that pay an unusual amount of interest. I recently got a mailer, 14% for a foreign bank. Well,
wow.
They're going to steal your money, it was going to happen. So just be cautious and you'll do fine.
Jonathan Pond, as always, great information. We appreciate you coming in again.
Thank you.
Okay.